Hello, and welcome to the latest special edition of the Sharesify podcast. We're delighted to be joined today by Deborah Aitken, Bloomberg Intelligence Senior Equity Analyst for Luxury Goods, to discuss the outlook for the sector. Deborah, welcome to the show.
Thank you. Thanks for having
Now,
me.
it's a pleasure. And how far along is the global recovery in luxury goods spending, in your view? And perhaps, has the Middle East conflict set it back a bit? And if so, perhaps in what ways?
So I think if we look at the end of 2025, we probably are back to parity, but it's been a real volatile few years. But when we say back to parity, that's in revenue terms. If we think about volumes, we're down more than 10%. If we think about the last 2.5 to 3 years, we've seen so much price increase to absorb tariffs, to absorb higher costs, higher wage inflation. And now we think 2026, our view on 2026 is around 4 to 5% growth after being static last year, a better second half, and down around 2% the year before. If we think about bringing in the Middle East on your question and where we are, well, if we look at overall around 32% of the market for luxury goods, and we're heading towards 40% personal luxury in dollars. So we would think around 32% is Europe. We're heading towards 30% now on very good beats the last couple of years from the US. And Middle East is actually 4% of sales. So not big. However, what you do get, first of all, luxury for locals, they're shopping again. But when we think about Europe, the transfer of wealth into Europe as tourists, particularly into areas like Paris and flagship stores, the big department stores, that's still very much down by about 30-40%. And we would expect that to be some of a drag, particularly for the middle income and high net worth individuals. But for some of the ultra high net worth individuals, we are seeing those come in. So overall, Middle East, we expect down around 150 to 200 bips. For the full year if we continue in the vein we are presently, but that is more than made up from the US and from quite a robust Europe actually, and so we're still saying 4 to 5% growth despite the big changes through the year so far.
The area you haven't mentioned is sort of by its absence, I'm thinking therefore Asia and I'm guessing China are a significant chunk still of sales for luxury stocks.
They are, and they're doing their own thing. So the idea this year and through the second half of last year, if I think about the quarters, second half last year, we had 7 of our big luxury makers back into positive territory in China, growing year on year.
Okay.
And Q1, 8 of them, including Prada, back. Well, the only one that is outstanding for us is Kering, which we say will be back to growth second half. And so we're expecting China, from having fallen very heavily over 2 years, at around mid-single digit growth, and that is coming through, albeit still pedestrian recovery, but it is happening. It's happening slowly. Elsewhere in Asia, Hong Kong growing again, Macau growing again, Singapore positive, South Korea doing very, very well. We're hearing of many of our companies commenting on South Korea. So it's pockets still. We're watching China very much, but if we think about the market overall, we would say China is around now within the Greater China region and as part of the cluster. For Greater China, maybe around 10 to 11%, and when traveling overall, adding to around 17% of the market.
Well, that's really encouraging to hear you say, that growth is back in Asia.
Yes, it is once we get them back. And so we're looking at around 3 to 4% growth for the year this year in terms of contribution from China.
So I guess my question is, I've followed these stocks for a long time, and they've always traded a premium rating to the rest of the market because of the margins and because of the kind of moats. I think people like to talk about moats around them. The brands aren't easy to replicate and so on. But they're now back to trading, as you say, I think on a revenue basis, kind of back to normal. To me, I wonder, are they going to trade at a premium from here on in, do you think?
I think if we look versus the MSCI World and what's happened on the S&P, some of the premium has diverted, or it's lost some of the premium versus the wider market. But if I look at some pure plays, you're still purchasing Hermes on over 30 times. A Richemont, which is the owner of Cartier, Van Cleef and Arpels, you're buying over 25 times forward PE. So there's still a big, a big not benefit, but certainly a premium, back to your query there, in terms of what you're paying for these stocks. So some brands have longevity. For an LVMH, though, the premium actually versus the wider market, and given the K wealth impact and tech, and how we've seen the premium rise on the global side of things, versus the LVMH is trading just under 20 times. And if we go a few years back, it was nearer 23, 24 times, specifically for LVMH. Wines and spirits still needs to make some recovery as the market, and then for itself. Also with tourism. So it used to have a very big exposure to Asia and tourism with DFS, which is in its selective retailing division. That was sold off to CTG Group, but it still does have big dependency, the same as some of the other big companies, to tourism. So it will need to do more with its big brand, Louis Vuitton. It's doing very, very well with Dior and others, but I can see why the premium is not what it was for LVMH overall. If we go to the wider group, then it's actually very interesting, because you probably range from solid stocks and solid stock performers until recently. So, let's think of aspirational entry-level luxury. You can buy into that at 16, 17 times versus 30 times at the very high end for those that are expected to bring through 6 to 8% top line growth and double-digit earnings growth on a long-term view. So it's about whether there's longevity in the brand, really. But overall, I think there's premium there because they're so cash generative versus the rest of the market, and they have a history and they have belief. And there's the other thing, a big Gen Z transition. So I do think there's some premium there, but I think it's hard fought at the moment.
Right, that's really interesting. And in terms of segments in the market, which sort of pockets are exhibiting the superior growth? Would it sort of be hard or soft luxury, or the high end or more accessible luxury?
All of the above. So particularly in end of 24 through 2025, it was hard luxury. But in particular, I would separate out watches, because that was really so volatile because of the tariff situation and the made in Switzerland, and at one point the 39% tariff rate. The big outperformer on the hard side has been jewelry, and partly we saw that linked to China and some purchasing power away from real estate into gold. So we had local brands like Laupu Gold doing very, very well, but also even at the higher end on luxury, like as we've mentioned, Cartier, Van Cleef and Arpels, Bulgari and others doing very, very well, because you're buying into something where you think there is longevity, and also where you think there's a very good resale market, because that's something in the market nowadays where secondhand pre-loved has a real ticket price, and that you feel that there's a base to that. And it was very much more for brands like Richemont and others that was way above where the gold price was moving, even at peak, if you're thinking about it versus per ounce. So certainly hard luxury did very well. In terms of soft luxury, we had a huge amount of creative director changes over the last 2 years. So if first creative direction drops, collaborations and others came in, they were hot. And for example, one that I can think about is the list index, where number one, again, we have Chanel. And Chanel has done very, very well at the high end with its bags, its leather goods. Dior is up in the top 5 as well. So there really is a mix of brand, but in category, it would have been jewelry, hard luxury ahead of everyone else. But that said, also for watches, I'm just going to cycle back, because actually on the watch side, the high brands have done very well. Watches of Switzerland has a big link with Rolex, and we saw not only for new but also for the second hand, the CPG market, where they do certified pre-owned. That has taken off very well. A lot of their high brands doing very, very well. The US really picking up on the watches market. So it's been across the board, but it's been quite brand specific outside of the jewelry sector.
Right, no, that's really interesting. Are there any kind of brands or companies that are doing a particularly good job appealing to the kind of Gen Z consumer?
Well, I've mentioned Tapestry, so I'll start on the aspirational entry level side. I would say that in terms of the way that they talk to the market, and I think Gen Z is about talking to the market. I think if we, that 1990s to 2012 age, and if we think back versus a few years to now and to 2030, things like the Boston Consulting Group will say from a mid-single digit percentage of the luxury market, they will be 25% by 2030.
Wow.
So every brand out there needs to be talking to Gen Z. And that is what, for me, has shifted this from, because we were very much behind the curve pre-COVID, the luxury market versus general retail in terms of online. You have to have your messaging across now online, on TikTok, straight into Insta, so many different social media sites, as well as third-party e-commerce, as well as still invested in your flagship so that you can prove what your product is about and give your identity on the street too. So yes, there are new brands there. I can think of Tapestry's Coach brand, having had such a good run. Very good, solid double-digit growth last year as well, 10%. Into this year, still a solid view, a solid outlook, but for mid-single digit, against a much higher base, of course, because these companies now are rolling into the billions in revenue. And then other brands that are doing particularly well, we've seen a very solid run from Ralph Lauren. So you could say entry level upwards, and into some parts of its business into the luxury side. And then Jacquemus is another brand. So L'Oreal actually took a small stake there to help them out. Over $1 billion of sales, a small stake there to help them out with their beauty side. And that's often Issey Miyake, which I always thought of, yes, as being a one-off designer, but doing very, very well with its fragrances and others. And so there are many, many brands out there that are really starting to appeal to the younger generation. And one of them I actually just saw, so the List Index lists the 20 hottest social media and searched brands across the luxury and affordable luxury and entry level space. And one brand that was really interesting to see come into the top 10 was, so they run 20 brands, sorry. So coming into the list was Massimo Dutti. So that's Inditex owned.
Oh. Yeah.
So, and that's come through. And actually, when you look at the price points there, you would say they would be mid-market rather than the luxury side, and very much pulling on a brand and doing very well in what they're doing online as well. So there's something for everyone if they can get the social messaging right. And that is very much linked to that Gen Z personalization, being there, pop-ups, experiential, bringing cafes and others into spaces. The big brands are doing it, but the small brands are starting to do it very well too.
That's brilliant. I mean, I think, unfortunately, James, I think we're going to run out of time in a minute. We've got so many more questions for you, Deborah.
Are we? Sorry.
Yeah. It's been absolutely brilliant to get your insight, and I'm sure there's more than a few followers of fashion out there in our audience. So I'm sure they will have enjoyed that. Thanks ever so much for your time. Really appreciate it. And to everyone who's tuned in, stay tuned for our next one. Bye for now.
Thank you.